Good morning to one and all. Welcome to HM Stocks. Today we are going to discuss about bearish candlestick patterns. Last class we have learned about bullish candlestick patterns. This time we are going to learn about bearish candlestick patterns. So the first one is hanging man. When you see this graph, you will be knowing that the bearish candlestick pattern is found in an uptrend graph. So let me explain you. The hanging man is the bearish equivalent of a hammer. It has the same shape but forms at the end of an uptrend. As you can see, it is formed at the end of an uptrend. The trend is upwards like this. The trend is upwards, but it's formed at the top of the uptrend. So it indicates that there was a significant sell-off during the day, but the buyers were able to push the price back up again. That means that there was a selling pressure during the day. Like, see, the stock price has started at here. What happened then? The bulls tried to pull the market. Again, the bears came into the market and pushed the market completely down. Again it has closed at this point. So this proves that the sellers are going to enter the market. So when the sellers enter the market, you have to wait for the correct time and you have to see the pattern of hanging man. So next, the large sell-off is often seen as an indication that the bulls are losing control of the market. At this point, you can see the bulls have completely taken the market to an upward trend, but at this point, the bulls have been vanished from the market, and you have to wait for the confirmation. When you get the confirmation, at the next point, you have to always take a sell order, so that the potential direction is always downwards. So the stock will be going downwards. So when you take a sell order, you will be gaining a lot of profit. That is how you have to analyze the hanging man. So next, shooting star. As you can see, this is also an uptrend graph in which you can find this kind of pattern. So the shooting star is the same shape as the inverted hammer. So you can see this is in the form of an inverted hammer with a long wick and a short body. Okay, but it is formed in an uptrend. As I said, it has a small lower body and a long upper wick. Usually the market will gap slightly higher on opening and rally to an intraday high before closing at a price just above the open, like a falling star to the ground. So you can see in this, like, it was an uptrend market. The market opened it here. So what happened? The bulls took the market up to here. Then suddenly the bears entered the market and they pulled down the price from here to this point, and it got closed at here. That means at the time it has fallen from here to here. So next day you have to see where the market has opened. It has opened at this point. Okay, when it opens at this point, that's a confirmation that the bears have entered the market. So at that situation, you have to always take a sell order. So the potential direction is always downwards. So the stock will be falling downwards. So next, bearish engulfing. In the previous video, we have learned about bullish engulfing. Now we are learning about bearish engulfing. Okay, so a bearish engulfing pattern occurs at the end of an uptrend. It will be always, the bearish patterns will be always in an uptrend. It will be found in an uptrend pattern. The first candle has a small green body that is engulfed by a subsequent long red candle. So that means first there will be a red candle which will be engulfed by a red candle which is huge than the green candle. So as you can see here, the red candle is, like, compared to red candle, the green candle is pretty small and it has engulfed, the red candle has engulfed the green candle. So that means that the bears are taking the control of the market. So you have to always take a sell order at this point. It signifies a peak or slowdown of price movement and is a sign of impending market downturn. So it shows that the market is about to reverse its trend and go to downwards. Okay, the lower the second candle goes, the more significant the trend is likely to be. See, the second candle has gone lower from here to here. It's gone lower. So that means how much lower it goes, so much significantly we can trade. So if it is like that, all the time we have to take a sell order. The potential direction is also downwards. So next, evening star. As you can see in the previous thing, we have learned about morning star. Now we are going to learn about evening star. Okay, the evening star is a three candlestick pattern that is equivalent of a bullish morning star. It is formed of a short candle sandwich between a long green candle and a large red candle. So you can see it's like a sandwich pattern, and a candle is formed between long green candle and a long red candle. So a small candle is formed between these two candles. It may be of any color, it may be red or white or green. Okay, so now it indicates the reversal of an uptrend. When the graph is up, when you suddenly get this kind of formation, that means the trend is going to be reversed. Okay, and is particularly strong when the third candlestick erases the gains of the first candle. That means this red candle erases the complete gains of the green candle. So green candle started at here and it got ended here. You can see the red candle same way, it has almost started at the same level, and it has gone more than the green candle. That means it has taken over the market. That means that the graph potential direction will be downwards, so that the sellers are entering into the market. At that point of time, you have to always take a sell order to gain your profits. That is how you look at a evening star. So next, it's about 3 black crows. How to analyze this pattern, I'll be explaining you. The 3 black crows candlestick pattern comprises of 3 consecutive long red candles with a short or non-existing wicks. As you can see, there are 3 continuous red candles in an uptrend market. The market is upwards. Suddenly there forms a 3 red candles with no wicks or small wicks, as you can see. Okay, like this when it forms, you have to know that it's 3 black crows. Okay, so each session opens at a similar price to the previous day, but selling pressure pushes the price lower and lower with each close. That means, one second, so the graph has started here, the candle has started here, and it has ended at this point. So next day when the market opens, it has opened at almost equal, same. Okay, here it has opened. Here it has opened and it has fallen completely till here. So again the next day the market has started at here and it ended at here. That means that each and every day it's going lower and lower. The price is going lower. First day till here, second day till here, and third day till here. That means that there is a steady fall in the stock price. So that is a very strong signal where you can take a sell order. Okay, trader interpret these patterns as the start of a bearish downtrend, as the sellers have overtaken the buyers during 3 successive trading days. Continuously 3 days the bears are having the upper hand in the market. So that means that is a strong signal for a downtrend, and you have to always take a sell order during this kind of candlestick pattern. Okay, so next, it's about Doji Candle. Doji Candle is one of the most important candle in which you can analyze using it. It's very important. When a market opens and closes are almost at the same price point, the candlestick resembles a cross or plus sign. As you can see, this is in a shape like a plus sign. So you can see, and also the open and close is not too far, it's almost close. The value of opening and closing is also too close. Okay, traders should look out for a short to non-existing body with wicks of varying length. That means that the body, you can observe the body of this candle is very short, but the wicks are very long. In same as well as in this red candle, you can see the body is very small, but the wick is too long. Okay, the doji patterns convey a struggle between buyers and sellers that result in no net gain for either side. So that means that nobody has won, neither the bulls nor the bears. It's like two parties, they fight, and the price will not be increased or will not be decreased, it will remain constant. Alone a doji is a neutral signal, but it can be found in a reverse pattern such as the bullish morning star and the bearish evening star. As you can see, in the evening star there is a candle formed between this green candle and red candle, this small candle. This is known as a doji candle. After this doji candle, you can see there is a reversal of trend. So according to this doji candle, we can trade in a positive way and we can earn good profits. That is about doji candle. So that's it for the day. Thank you. Hope you all understood the class, and by this methods I am concluding about candlesticks. If you have any queries or any doubts, you can contact us anytime. We'll be available 24 hours. So thank you guys.